Hi, everyone. Welcome to today's PENTalk. I'm Beth Parker with Pentegra. We're glad you joined us today. We still have some people signing in, so I'm going to go over a few housekeeping items before we jump into the presentation. Please find the control panel that's located on your screen. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule today and end on time. If we don't get to your question today, we'll definitely follow up with you afterward. Tomorrow, you'll receive an email with a link to replay today's broadcast, and it will also include a link to the slide deck. Okay, let's get started. We're joined today by one of our favorite presenters, Rich Rouser, Senior Vice President and Client Services of Pentegra. Rich joined Pentegra in 1997 and has traveled the country visiting over 1,000 clients. One of his favorite things to do is to share his knowledge with others on the importance of retirement and savings strategies. Rich, thanks for being here as always. Let's get started.
Sure. Thank you for the introduction, Beth. By the way, feel free, anybody, to type any questions you may have as we go along into the Q&A panel, and we will attempt to get to all the questions if we can. We're happy today to talk about monetizing the Secure Act, and specifically what we're going to discuss is the notion of PEPs, group of plans, and some other ways of monetizing some of the aspects of the Secure Act. So, get my slides moving. One more slide. Okay. So there are a couple of new concepts in the Secure Act. A concept called a PEP, which is a pooled employer plan. There's also a concept called a group of plans concept. And really both of them, in our view, are really extensions of the multiple employer plans that have been around for almost forever. The traditional multiple employer plans came in two varieties, either closed MEPs or the somewhat newer version was an open MEP. I'll talk about both of those as we go forward. But the first thing I want to do with this group is do a little bit of a poll and get a sense of your insight into Secure Act and some of these new arrangements. Beth, if you could launch the first question we have for the group.
Right, it's up on the screen. Now, on a scale of 1 to 5, how would you rate your knowledge of the Secure Act and the changes to retirement plans? Just real quickly, if you could pick one of your answers there. We're seeing results coming in already. We'll give it about 10 more seconds before we close the poll and we share the results. Okay, let's close that and
all right, good. I don't know if the group can see the numbers. I can see them here. I'll read them out. You know, we did a 5-point scale on this question, ranging from excellent level of knowledge down to poor. So starting with the midpoint, about half the group today has about average knowledge. 33% are saying above average, and 13% excellent. There's a slight 4% below average, which is good. It sounds like we've got a knowledgeable group, which is good news. So hopefully we'll get some good questions as we go along here. Turn my slides. There we go. So a couple of things that we are definitely going to get into this afternoon, and hopefully the answers to these questions will become apparent as we go through. But we're going to talk about PEPs and GOPs, as I call them, group of plans. What are they specifically? When are they available? How do they work? How are they different from each other? I will talk about the governance structure of the newer versions of these programs as well as traditional MEPs. We'll get into why use one version over another, and also really honing in on how you can participate in these new arrangements. And I want to talk specifically about how you might be using them with your clients and prospects, and give you maybe some ideas to think about in terms of potentially capitalizing on new sources of business and or revenue using these new arrangements. So, you know, at a very high level, just to get the nomenclature out of the way, MEPs, multiple employer plans, closed versions and open versions, those are what I call the traditional MEPs. They've been around forever. That's why we say available now. PEPs, pooled employer plans, right, available starting in 2021. That's the initial effective date is defined by the Secure Act. And GOPS, as I call them, actually there's a typo. It should say group of plans, not plural. It is a group of plans, first available in 2022. I have special mention on this slide of a couple of other multiple employer types, which are ARPs, Association Retirement Plans. They became more readily available, I should say, sometime last year in 2019. There were some final rules and regulations published in 2019 that clarified some aspects of how you use them and made them a little bit simpler. Same thing for PEO, Professional Employer Organization Plans. Again, both of these are, I'll call them variations of a multiple employer plan type structure. I'm not really going to spend time on those today. I'm really going to focus more on comparing PEPs and GOPs, as I call them. So with that said, let's go over a couple of the characteristics of what I'll call the traditional multiple employer or MEP structure. Again, these are the versions of multiple employer plans that were available prior to the Secure Act. And as I mentioned before, they come in two flavors, either closed or open MEPs. Closed are the more traditional. They, generally speaking, need a nexus among the group of employers or some sort of commonality. They are deemed to be a single employer plan for reporting and audit purposes. And what I mean by that, there is a single 5500 form that's filed on behalf of the entire group. And in essence, there is a single audit performed on behalf of the entire plan. In a closed MEP, there is a concept of shared service for both eligibility and vesting. And what that means is if I happen to be working for employer A for a number of years, and if I leave that employer and for some reason end up working for employer Z, my prior service with employer A, because they were part of the MEP, essentially will count for my eligibility and for my vesting purposes once I join that other employer that happens to be in the same program. So, you know, from a record-keeping standpoint, from an administrative standpoint, certainly from a plan sponsor standpoint, that's something to be aware of. If you're part of certainly a closed MEP, and we're going to see that same instance carries through into the PEP environment, it is something folks need to be aware of, and it is something, you know, if you're thinking about the administrative level forms, it may be a question to ask if you're hiring somebody and enrolling somebody in another program that happens to be part of that multiple employer plan. A couple of comments on MEPs. I call them more traditional MEPs that have been around for a while. The concept of open MEPs, we've actually run a couple of those for the last 4 or 5 or 6 years. They're definitely not a single employer plan for reporting purposes or audit purposes, or even for shared service purposes. The one comment I want to make on traditional MEPs, pre-Secure Act MEPs, is our view of the governance structure. In a typical closed MEP or pre-Secure Act open MEP for that matter, we're typically seeing a governance structure where there's typically a board of directors or a retirement plan committee that is overseeing top level of the plan and in essence representing the views of the clients that are participants in that program. So, that governance structure is, I think, going to be different in the new environment of Secure Act PEPs, and certainly in terms of the group of plans. So PEPs are essentially called pooled employer plans. There is something called a pooled plan provider. I call it the triple P. That is really the name fiduciary of the plan and is responsible for what I would say are a lot of the day-to-day administrative aspects of the plan. We're going to get a little bit more in depth on that in a while. But again, a PEP in and of itself is a multiple employer plan. There's no commonality or nexus in these arrangements. Essentially, they can and will be unrelated employers. It is a single plan, though, right, in terms of a couple of concepts, in terms of shared service for eligibility and vesting purposes. So again, what I mentioned before on traditional MEPs, where you kind of need to be cognizant of an employee's date of hire and their level of length of service with any and all of the employers within that program, that shared service is still a concept here. Now, so for reporting purposes, and what I mean is, 5500 purposes, there will be a consolidated 5500 filing. Essentially, the details of all of the individual plans get rolled up. That's at least what we're thinking. The guidance that we have so far is that there's going to be a new version of that 5500 form, and there's probably going to be, actually, there will be additional details on an employer-by-employer basis. Probably not much different from the additional detail that we see on current closed MEPs. So that's something that we fully expect. In terms of audit relief with PEPs, there is some what I call audit relief, certainly in the early stages of plan formation. They're basically saying under the law that an audit is not required until the head count or the participant count goes over 1,000 participants, and or there's an exception if any one employer within that PEP exceeds 100 lives, and the audit requirement does trigger or tip in. So, in theory, in the early stages of a PEP, there could be some relief or flexibility in terms of not having to conduct a plan audit. And again, I mentioned earlier, the governance structure of a PEP, in our view, is definitely different from what we've seen in the closed MEP environment. I don't necessarily anticipate a board of directors or necessarily a retirement plan committee. The structure of the plan, which we'll get into in a few minutes, is different, somewhat different from a closed MEP scenario. So let me talk next about GOPS, group of plans, as a concept. A couple of things here. There's no nexus or commonality. They're essentially individual employers. A group of plans is definitely not considered to be a single plan, but there will be an aggregated or consolidated 5500 filing. That's yet to be determined, or yet to be drafted, I should say. We're expecting, I guess, that the service would put a form together, 5500 filing form together, that is appropriate in terms of the data that they want to see. There is an aspect of the law that basically says, as a participant in any of the underlying plans, I should be able to identify information relative to my employer under that program. I think we're going to need some guidance to truly understand what that really means. I don't see any provision in a group of plan concept, by the way, for any audit relief. There's no mention of it at all that I can see. And there are some very specific requirements, 6 very specific requirements in order for some of these plans to be considered a GOP, or a group of plans. So the picture we painted so far, right? We've got traditional MEPs, Pre-Secure Act maybe is a better way to put it. We have PEPs, and we have group of plans as a concept. One of the purposes today of this discussion is to figure out, well, we're hearing a lot of interest in these programs, right? We're hearing from financial advisors, we're hearing from record keepers, we're hearing from mutual funds and other investment advisors, from 338s and even providers of ERISA 316 services, that there seems to be a high level of interest, and the big question is, how can each of them participate in a PEP or even a group of plans concept? So really, that's what we're going to try to get to today. How would these things work? What are the elements that need to be considered? What are the various duties and functions that need to be attended to? Beth, you can move us to another slide. We've got the next slide coming up should say, when are MEPs, PEPs, GOPs the right opportunity? So, yep. And this is what I've been speaking, right? This is what I've been speaking about. We need to kind of hone in on if you're interested in participating, where exactly are you going to play within, or what jobs are you going to fulfill within each of these different environments? So with that said, we're going to dig deeper. We're going to continue to peel this back and figure out what's going to work best. So I'm going to move up to a slide that talks about the various roles that need to be filled in either a PEP or a GOP. And at the top of this slide, I started with an aspect of PEPs that it requires what's called a triple P, a pooled plan provider. Essentially, the triple P is the named fiduciary under the plan, is by and large responsible for a lot of the administrative tasks under the plan. I'm going to get into more detail on that in a minute, and I'm going to talk about how that pooled plan provider position can be potentially structured. So some of the other elements in both of these arrangements, whether it's a PEP or a GOP, is the other elements that really kind of fill into any qualified plan, right? Typically, there's a financial advisor who may be involved. There's a trustee and or a custodian. There's typically an ERISA 316. Investments, typically mutual funds or maybe managed accounts, right? There is maybe typically in these is an ERISA 338. Certainly the larger arrangements would have an auditor. There'd be a record keeper, potentially ERISA attorney, certainly a need for plan documents, let's put it that way. TPA firms are going to be involved to the extent that there's obviously testing and compliance and 5500 forms to prepare, as well as maybe benefit calculations. And there's, a role for potentially a retirement plan consultant. And I'm thinking about certain situations where certain clients may need certain advice on the various arrangements. So with that, these are the roles that I see out there, and I can think of these roles. And if I think about a PEP for just a moment, right, where there's a triple P involved, I can think of a PEP structure where potentially an organization could actually fill almost every role under the sun, right, soup to nuts in terms of running a PEP. Could they be the record keeper? Could they have a division of the company that provides the 338 services to the underlying clients? Could they either become a 316 or be the 316 on the plan, and or maybe outsource a portion of that, right? Financial advisor. All of these roles in theory could be done by a single firm. On the other hand, the way we think about this and the way we think of the various parties involved in terms of servicing retirement plans, there may be more opportunity for individuals who fulfill these very specific functions to work together, right, to put a package together, or put a program together. So I could see, for example, a record keeper establishing a PEP and an ERISA 338 being involved, right, in terms of providing the investments to the underlying client. So a couple of different ways to look at this, and I could also see some or all of the 316 services being, I'll call it outsourced, right, or maybe room for somebody who might be a specialist in that segment of the retirement plan services marketplace to be involved. So obviously, any of what I'm saying is really going to be subject to some guidance. That is the big thing. The law has been published. The basic rules are out there. The specific nuts and bolts of how this is going to work are yet to be determined, right? There's going to be some guidance along the way. There is basically a notation in the law that says, look, could you actually start these things right now and build them to the best of your ability using, I'll call it a good faith compliance type of a structure? And the answer is, yeah, that's definitely possible. But, there's certainly some things that are going to be changing over time. So before we get a little deeper, let me just talk a little bit deeper about the triple P, the pooled plan provider. Now, I mentioned earlier that's going to be a named fiduciary under the plan. That's a person or an entity named in the plan document. And the way this structure is going to work is each adopting employer essentially is appointing the triple P. So again, I envision a PEP type structure with a triple P that's named in the plan document, and each employer who comes into the program is essentially appointing that triple P, right? And that is a fiduciary decision that employer makes. By the same token, the way the basic structure of a PEP is set up, each employer is responsible for the investments and or, I assume, naming an ERISA 338 to be responsible for that portion of the program. So again, that is technically another fiduciary role borne by the client. There is a provision in a PEP for the triple P, the pooled plan provider, to actually name an ERISA 338 or name the investments that are available under the plan. So again, the way I see these things put together, there are a lot of components. There are a couple of different moving parts that are common to any retirement plan that exists today. So again, the way we see this is that we see various specialists serving various aspects of the plan, whether it's the record keeper, the 338, the ERISA attorney, the TPA, and so on. So the basic structure is more flexible Certainly it's more flexible, I think, from a governance standpoint than a closed MEP. Actually, the interesting aspect of a PEP is that each employer doesn't necessarily have to have the same 338 or even investments. I'm not sure how that's actually going to work out. I'm not sure if I was the record keeper that I'd want to be record keeping a single PEP with multiple 338s underneath, or so that's something, if I was a record keeper, I'd be looking at closely and trying to figure out how could I be as efficient as possible, and how would I actually structure this arrangement to either say, no, we can't record keep multiple 338s, or maybe you can, and maybe that is a solution that some record keepers can bring to the table that others can't, or maybe don't want to. A couple of other things here. There is some other guidance in terms of PEPs that are interesting. There's the one bad apple rule. That was always a little bit of a concern, or maybe a lot of concern, depending upon who you were, in terms of a typical closed MEP. Right? In theory, if there was a material defect with one employer, in theory, it could potentially disqualify the whole plan. We haven't really seen that even in the closed MEP environment, certainly not in our experience, put it that way. Because again, by and large, most of the closed MEPs that we're involved with are DC plans, most of them individual account plans, and most of any issues that we find are usually corrected at that employer level. But PEPs do have provisions for what happens when things go wrong, and it does permit a bad apple to be, my words, kicked out of the program, kicked out of the plan. And it also does talk about the ability to potentially correct some of the issues within the program without moving them out, if that might actually be a better solution. But all of those are going to be subject to some future guidance. So the bad apple rule is certainly less of a concern in terms of the PEP environment. All right, so we're going to move to another slide here now that we've kind of peeled back the envelope on the various roles that are available. We're on the slide, right? Duties and responsibilities of the PEP and the Triple P. Okay. So the PEP plan document essentially is going to name the pooled plan provider, the Triple P, and the trustee or trustees. As I mentioned before, the Triple P is the plan fiduciary under ERISA. I'm not going to go into the code or the ERISA section for now. And here are some of the duties that the Triple P is responsible for, right? And this is all from the law. Testing and compliance issues with respect to the underlying qualified plans. Got to register with the DOL, got to acknowledge fiduciary status in writing, got to ensure ERISA bonding for anybody who handles funds in the plan, responsible for preparing and filing a 5500, and obviously subject to whatever the new DOL audit requirements might be. And again, at the bottom of this slide, I'm talking a little bit or a lot about the investment decisions, right? So the basic structure is it's really a participating employer decision in terms of the investments utilized for their portion of the plan. Those duties could actually be assumed by the pooled plan provider, or the pooled plan provider steps in and handles that function, or appoints potentially a 338. That's the way we see that working. So at the end of the day, I think we're going to see when these plans are formed, when PEPs are formed, we're going to see a variety of operating conditions with respect to that element in terms of naming the investment fiduciaries under the plans. And we're going to see it either at the employer level or at the Triple P level. So that'd be kind of interesting to see how that develops. So moving a little bit further, this is, again, just some of the nuts and bolts of the PEP itself. We probably don't need to spend a lot of time on this, except to talk about, I want to jump down to talking about trustees. There is something in the law where essentially the trustees of the plan have to be responsible for collecting contributions. That's a little bit different, and that's probably one of the tougher things to manage, I think, going forward. So I think we're definitely going to need some guidance on that, because I'm not sure most trustees right now today are directly on the front line in terms of, I'm going to use the word, proactively collecting contributions. So that's interesting to see. I see more of monitoring timeliness of contributions, but not necessarily proactively collecting. So again, guidance and maybe more definition around that is definitely going to be forthcoming. And again, I mentioned this before, each employer who joins a PEP is going to technically be responsible for appointing and monitoring the Triple P, technically responsible for decisions on the investments unless they decide to delegate to a 338, or, of course, as I said before, unless the Triple P assumes that role. The other thing in the law, obviously, I shouldn't have to say it, is that each adopting employer is expected to comply with various tax laws, right? And again, guidance forthcoming on the bad apples that may need to be removed from the program. So what do we know and what do we not know about PEPs, right? This is just kind of teeing up the concept and also getting you a little bit focused on what role do I want to play within the PEP environment if I want to be involved with it. So definitely more guidance and rules to come, not effective until 2021. In theory, you could start to ramp up to build on it now on a good faith basis, subject to some changes you might have to make based upon rules down the road and guidance coming forth down the road. All right, so we're going to get into GOPS, Group of Plans, as a concept. I bring this up because, it's interesting. Most folks that I talk to, whether they're 338s or record keepers or mutual funds or investment advisors, right, most have been talking about PEPs. How can they be involved? How would it work? How can it be structured such that they play the role that they normally play? Not very many, a few, but not very many have talked about a group of plans concept. Now, one thing, these aren't effective. You can't really do them the way I see them until 2022. So there's a little bit more of a delay or a gap between now and when you can actually start to utilize this concept. But I think it's a very viable concept, and it may warrant a second look if you haven't taken a look at the rules on this section of the Secure Act. So, a couple of quick things, 6 key elements. They all have to be essentially DC plans. All of those plans have to have the same trustee, the same name fiduciary, the same ERISA 316. They have to have the same plan year. And here's a key differentiator, right, from the PEP and the MEP. They have to have the same investments or series of investment options. So overall, they're not a MEP, they're not a PEP. Concept similar to PEP, they're unrelated employers, and they get to file a single aggregated return, 5,500 that's yet to be designed. Now, we don't see any audit relief per se in this concept, but I guess the question is, if you're a TPA, if you're a record keeper, if you're an ERISA 338 investment fiduciary, right, could you put or be involved in this type of an arrangement, and could you see any efficiency in terms of how you provide your services or you provide your function? And so to me, a lot of these plans are all about grouping various clients together to gain efficiency, to gain scale, to drive down the cost of running the program, right? And we're going to get into some very specifics of how the Department of Labor views these. So if we move up another slide, I don't see any audit relief. Nothing is even discussed in the law about audit relief in terms of groups, a group of plan concept. There is a consolidated filing. Some of these other things I already mentioned. No shared service among the employees, right? In other words, unlike the MEP and the PEP structure, where I said there is shared service concept in terms of eligibility investing among those various employers in the program, that we don't see that concept here. So again, more rules to come on this. And again, GOPs are not available until a year after the PEP concept. So really 2022 is when we see them coming down. So here's a couple of comments taken from the Department of Labor, specific to Secure and specific to a lot of what has gone into the Secure Act. So one of the primary purposes is to expand retirement plan coverage in the United States. And, the DOL in particular says, a significant percentage of small employers does not sponsor a qualified retirement plan. And the top reasons cited are regulatory burden and cost of the program. The DOL in writing has said, part of the solution to the coverage gap in this country is to provide small employers with access to high quality, professionally managed plans low cost, less regulatory burden. So when I think about all of those, well, with a PEP, um, and a group of plans and the traditional MEPs, right? To me, the regulatory burden is reduced, I would say, significantly, certainly in terms of direct responsibility and liability, right? Because there's typically going to be a professional ERISA 316, ERISA fiduciary operating the plan. So that's a layer of, I'll call it professionalism and protection that most small employers that I see don't have. So that is something that's definitely brought to the table for any employer that's part of any of these programs. And by the way, even though the DOL is focusing on small plans and the coverage gap, there's no reason larger plans, mid-sized and even larger plans can't participate in these programs. They certainly can. In terms of cost reduction, there I start to think about, well, how is that part actually going to work, right? Because if you think about the various functions that need to be done, right? There's record keeping that needs to be done. And again, each of these employers in a PEP or a GUP are really separate employers for the record keeping purpose. Certainly from a testing and compliance standpoint, they're separate employers. So, from a record keeper and or TPA standpoint, on the surface, I don't see a ton of efficiency that can flow through. Now, a couple of thoughts there. From a TPA standpoint, let's start there. Testing and compliance. Well, if I had a simplified plan structure, and I'm not sure this works in all scenarios, but if it was a safe harbor type plan where I don't have to worry about top-heavy testing, I don't have to worry about ADP or ACP testing, and maybe all I need to really worry about as a TPA is 402G limits and 415 limits maybe. I think from that standpoint, it certainly reduces the workload of the TPA, and therefore I guess what I'm getting at is, could their pricing be more efficient and more effective because there's less work to do? The answer I think would be yes. On the other hand, think about a safe harbor plan from the standpoint of a plan sponsor who's now venturing into their first qualified plan and now has certain employer contributions are required to make. Well, that to me is an expense. So I'm trying to reconcile, the Department of Labor's view of bringing high quality, low cost services to small employers, at essentially large plan pricing. So, from an investment standpoint, I could definitely see, if you aggregate the assets with one or a series of investments that are in common, I could definitely see breakpoints at certain levels. But again, when I think about investment expense, I typically see that as a kind of a participant cost, right? Most of those expenses are built into the funds themselves. So certainly there might be some advantage at the participant level, but we're still trying to figure out, so exactly how does this large plan program come down to small employers at a lower cost? Certainly, I'll speak about a 338 for a moment. Well, if I'm the 338 in the program, and if I've got a common setup for all of the employers that I bring to the table in this program, I could probably see some efficiency, definitely see some efficiency, because I'm really managing from a 338 perspective on behalf of the entire group. So any decisions that are made from let's say an investment fund perspective really apply across all the plans within the group. So could I see the pricing or the structure of that pricing be more effective? Possibly, right? But that's really not for any of us. That's really for the individual firms that are playing the various roles here, whether you're a record keeper, whether you're a TPA, whether you're the investment advisor. The question is, how would you fit into the program, and how would you think about pricing your services? So let's talk for a minute about the keys, what we see as the keys to success in any of these programs. So the first thing I like to think about is each service provider really needs to see and think about what they see as their role within, whether it's a MEP or a PEP or a GUP or even an ARP, right? What's your role? And my guess, certainly in terms of talking to other retirement services professionals, their role is probably going to be their typical role, right? So if I'm a record keeper, or if I'm a 338, I probably want to continue doing that role as my primary job. So the next thing I like to think about is, well, can you actually perform all the duties required of the role? And I'll give you an example. If I'm a 338 and I want to form a PEP, right? Well, the first thing we need in a PEP is a pooled plan provider. If I'm really the 338, am I really going to be able to step into the role as the pooled plan provider? The answer is maybe yes, maybe no. Maybe I want to, maybe I don't want to. Maybe I want to, but the higher entity within my organization says, "Now we're not going to let you do that." But if I am able to serve as a triple P, can I do all the duties myself, or can I outsource some or all of the functions underneath it? And we're thinking, by and large, you can outsource many of the functions underneath the triple P. But again, from a front and center standpoint of being the named fiduciary under the plan, the question is, if I'm a 338, or if I'm a record keeper, or if I'm a TPA, do I really want to assume the role of a triple P if I'm not going to necessarily perform all of those functions? So again, think about what the role you want to fit into. Think about, can you fit into it? Can you actually do the entire job, or do you need to outsource certain components? Ultimately, once you've kind of thought through all of these aspects of it, you need to define your specific role. Is it going to be the role that you've normally served in terms of what you do right now today in terms of the retirement plan market? The other thing I have been calling attention to is creating a sales and marketing plan. There's a lot of talk about PEPs and these new structures, and I think a lot of excitement in the industry about, well, they sound great. So the question is, are they, if I build one of these, are new clients going to be knocking on my door saying, I got to have it? I think the answer is, we in the industry are going to need to look at these new arrangements just as we've looked at all the other arrangements in the past. They really need to be sold. And if I look at the small to mid market, the micro to small to mid, I mean, really, typically there's an FA involved, or a 338 that typically, or even certainly an accountant or attorney or other advisor, if you will, who typically brings that client into the gets them up to speed with the notion of adopting a qualified plan. So merely building a PEP or saying, hey, we have the ability to do a group of plans, I don't think the clients knock on your door. I think we still have to go after the prospective clients and show them why this arrangement may be better than any other option under the sun. So creating a sales and marketing plan, I think, is crucial. Now, as an organization, we have a lot of experience with closed MEPs as well as open MEPs. And we have a lot of experience. I'm just going to share with you, right? We have real good track record experience in terms of what makes a successful MEP in general. And the bottom line is, it is typically scale. And the scale brings efficiency in almost everything we do, whether it's a record-keeping function or whether it's a TPA function or whether it's the investment side of the equation. Scale definitely helps solve that dilemma of how do you make these successful. We also have track records on certain situations that have not achieved reasonable scale. And, here's the bottom line. They just really don't work. If you create one of these programs, you really need to think about how you're going to sell into it, how you're going to market it, and how are you going to distribute, so to speak, and get employers to join the program. So the other thing that I mentioned earlier is to keep your options open. Again, a lot of folks are thinking about just either a PEP structure or a group of plan structure, and I say, you know what, there may be room for you on more than one side of the equation. So I like to say keep the options open is I think a big piece of this. The other reminder here, I'm going to ask you, we're going to do another polling question, Beth, in a second here. There is no single best solution that works for everybody. We find that, even in the new world of PEPs and GOPs, there's still going to be a need for single employer plans. There's still going to be a need for more traditional closed MEPs and even maybe open MEPs. I haven't really thought that one totally through, but I wouldn't eliminate any options. Eliminate any options at this point. I also say, consider traditional solutions, which, by the way, may actually include non-qualified arrangements. Beth, can we run that next survey question, please, for this group?
We're Rich, we're a little bit over time right here. I think maybe we should just advance on to the
All right.
summary.
Yep. I will move to the summary. Anybody who's written any questions, we will definitely get back to them afterwards. So in terms of the summary, we like to say, look, you got to look at each situation, right, specifically, and make sure that you're ending up with the best solution for your client. If you are going to get involved in PEPs or a group of plans solution, you need to make a dedicated effort, really, to make sure you're going to market and sell into the program. I think we still need to do the traditional level of work in terms of putting these things together, and also making sure that you're seeing your role in these new arrangements, figuring out how you want to get involved, figuring out what other partners you may need to help support the arrangement. Again, if you can't do all of the tasks on the list, you need to kind of figure out, well, who can serve as a 316 and who can, be the record keeper under the plan if I'm not a record keeper, TPA, so on and so forth. So it's crucial. Don't forget, single employer plans are still a solution, and to look at all your options. So with that said, we are, again, a little bit short on time. I thank everybody for participating this afternoon. We will get back to you if you've got any questions. We'll get back to you after the webinar. And Beth, I think we said after the webinar, we'll be able to release a recording of this as well as a copy of the slides. So with that, I
correct.
Thank everyone.
Everyone will receive an email tomorrow. Thank you so much for your time.